Chair now recognizes the gentleman from Maryland, Mr. Delaney.
Thank you, Mr. Chairman. And I want to thank you, Chair Yellen, for not only your leadership in general, but also your participation and patience at this hearing. I also want to welcome our visitors and guests here today, and thank you for bringing your important message. We do talk about how our unemployment rate has gone down substantially, which it has, below 5% now. But we all know that when you get behind those numbers, there's really only two types of jobs being created right now in this country: high-skilled, high-paid jobs. We need very, very specific skills, advanced educations to get those things, and low-skilled, low-paid jobs. And what we're not creating is middle-skilled, middle-class jobs, the kind of jobs that have been the backbone of this country for a long time and allowed wages to grow and people to raise their families with one job. And the chair touched on something very important, which is infrastructure, because there's nothing we can do as a country to help address more than rebuilding our country. So if I could ever edit your T-shirts, I would say, let our wages grow, comma, rebuild our country, because I do think it would really make a difference in raising wages. But my question for the chair, and again, thank you for your patience. In December, when the decision was made to raise the federal fund rates, in your testimony you said that was in part based on a view that economic activity would continue to expand at a moderate pace and labor market indicators would continue to strengthen. And certainly, based on the top-line data from 2015 and 2014, where we saw decent GDP growth, improvement in the residential market, business investments at a decent level, not where we'd like them, but at a decent level, increases in R&D investments, et cetera, that even when you take into consideration the negatives from the oil and gas sector, the outlook for economic growth was reasonably solid. And the labor market data that you were looking at the time must have been good, because the January numbers were actually encouraging, not only in terms of unemployment, but some of the wage data, as you talked about. So I guess my question is, a lot's happened since that decision in the markets, and that tends to change behavior. When you look at the same data you looked at when you made that decision in December, if you look at that data now, does it change your view as to your perspective on economic activity, economic growth, and general labor market trends?
So I think the answer is maybe, but the jury is out. We've continued to see progress in the labor market. Over the last 3 months, there have been 230,000 jobs per month averaging through. GDP growth clearly slowed a lot in the fourth quarter. My expectation will pick up this quarter. But on the other hand, financial conditions have tightened considerably, and that can have implications for the outlook. And what the committee said in January, we had previously said that we regarded the risks to the outlook for economic activity and the labor market as balanced. Right. What we said in January is that we're evaluating and assessing the impact of these developments on the outlook for both the labor market and activity, for inflation, and the balance of risks. And that's what we're doing at this point.
And when you look, Chair Yellen, at recent data that you get better than anyone about credit formation and borrowing activities in the markets, are you concerned that there's been a significant contraction in credit availability based on recent market activities? And how much does that factor into your...
Well, that is an important factor.
And have you seen it?
Well, not really at this stage, but what we do see is that spreads, especially on lower-graded bonds, have widened considerably. Borrowing rates have widened.
What about bank lending?
And it's not just energy. In our most recent survey of banks on their lending standards, we've seen a tightening that's reported in C&I loans and CRE loans, and that certainly those loans continue to grow, but that is something that bears watching. And it's really those kinds of trends that we need to evaluate.
And very quickly, as you weigh your Obviously, inflation and labor market participation are critical. Overall view of economic activity is critical. This subcomponent, in other words, what's happening with credit availability, how important is that in your decision-making process?
What we're trying to do is forecast spending in the economy. Investment spending and housing are two important forms of spending, and credit availability factors in to our forecast for both of those portions of the economy. They're not the only factors that matter, but they are a factor that is important, and so we will be considering those. And, you know, there's a number of weeks before we meet again in March. There's quite a bit of additional data we'll want to look at, but you've pinpointed exactly the kinds of considerations that will bear on our thinking.
Thank you again.
Time of the gentleman has expired. The ranking member.